another. I'm like, guys, we're still in, this headline driven environment where if you're not paying attention to what's going on and, you get this emotional from seeing all these things coming down, it's not going to be yielding you any benefits long term. You still continue to stay in the state. And it just feels like we're the only community here that is just aware of these kind of things.
Dude, I'm telling you right now, I've already seen it on Twitter. I've seen like five different mainstream XRP influencers screaming at the top of their lungs, why is XRP crashing today? And I'm like, man, it's super unfortunate that people involve themselves in the financial markets, but don't understand how the financial markets move and what makes them move. It's weird, it's like it's actually super immature. It's really immature of people to try to invest in something, whether it's commodities, FX, stocks, crypto, and not actually understand the backdrop of you know, what fundamental developments actually create liquidity inflows and outflows of these markets. It's weird, honest to God. Not in this community though. So you guys are 10,000 steps ahead. All right, let's get started, guys and gals, because it is Sunday, so I don't want to keep you guys too long. Let's do a broad overview of where we're at in the landscape. It is not the end of the month yet, so we're not going to do a full detailed fundamental breakdown like we usually do, where I slap on all the fundamentals throughout the month and we just take a look back at what happened. But we are going to do a very brief overview and we're going to dive into the report. Can't I share my screen? We're going to dive into the report that I wrote for you guys yesterday. There have been some slight updates, but yesterday's report is still relevant to today's landscape, especially considering some of the sentiment that the Fed delivered last week, tariff implications, and then obviously the geopolitical escalations. So before we get into the breakdown and then full circling towards the end of this, I'm going to show you guys again why I'm still optimistic, even though cautious in the short term. Um, why I'm still optimistic, why I again believe that right now everything that we're seeing in the market is specifically headline driven. The underlying fundamentals in crypto have never been this bullish. Like literally 3 days ago, freaking JP Morgan announced that they're building out a tokenization product on base. Like, what the F? You can't be bearish on crypto when that type of stuff is happening. So, again, we're gonna dive into that. I'm gonna do a little bit of a presentation, just show you guys some institutional DeFi adoption that's taken place to give you guys some positive momentum, considering that we are in a slight risk off, and I shouldn't even say a slight risk off environment, an extreme risk off environment, but nothing new in this community. Okay. These are all things, again, like D'Angelo was saying, that we've been talking about for some time. So if you're new here and you're just kind of catching on, that's fine. Welcome to the community. But if you are and have been a part of this community for at least a couple of months now, you guys see exactly why we talk about this stuff in advance. So that way, when it happens, we're prepared. How many times have I told you guys over the past, like, let's just say 2 months, I'm not deploying capital. I'm not deploying capital. I'm waiting. I'm being patient. I'm looking for the market to retrace back down to $3 trillion before we deploy heavy. So that way, we're not buying at tops in a risk on market environment. We're buying at a discount in a risk off market environment. Well, now we're finally here. So we're going to start here just to go over the fundamentals. You can see that this is all the way back from May 17th. Well over a month ago, we were talking about this. I warned you guys that Trump had threatened back in March at the beginning of this year that he would bomb Iran if nuclear talks did not materialize and come into fruition. Right? You can see the screenshot here. This is a fundamental piece from Reuters back from March 13th, 2025. This was a discussion that we had on previous Zoom calls and something that I posted to you guys on May 17th. All right. So, yet again, another prime example of how we prepare ourselves, not only mentally, but fundamentally in this community to understand the landscape so that way we can react accordingly. And we're not freaking out like all the other retail investors because now, fast forward to most recent times, what have we seen, right? We have seen escalations in the Middle East intensify significantly. The U.S. striked Iran. The U.S. attacked three key nuclear facilities early Sunday, and an Operation Defense Secretary Pete Hegseth claimed obliterated Iran's nuclear ambitions. Though a full impact assessment is still ongoing, President Donald Trump warned in a White House address that the U.S. will launch more attacks if Iran does not make peace. And so, right now, we're still seeing these tensions elevated. Iran has mentioned retaliation measures. I don't know if anything's happened yet. I haven't checked fundamentals since I sat down at my computer and drawed out all these tabs for you guys. I will definitely do a reassessment as we roll over and transition into Asia session as the markets open up for Monday morning's trading. I'm just going to go ahead and outright say that we're probably going to see a gap up in gold. I wouldn't be surprised if we see a gap down in futures markets and stocks when the markets do open. Like I said, we have been preparing this, so this should not be anything new under the sun. The fact that the total cryptocurrency market is seeing blood today, down 3.45%, over $100 billion shed from the total cryptocurrency market. And this just goes hand in hand with one of our breakdown videos that we had back on June 2nd. So yet again, just to show you guys, I want you all to listen. For anybody that's new in this community, this is a call that we had from almost over a month ago where we specifically laid out what would most likely happen if we saw the scenario play out. So just listen here for a second. Japan trade talks, EU trade talks, any other major jurisdiction trade talks that aren't priced in yet. Remember, we're still awaiting for the Japan finance ministers to meet with Washington surrounding their tariff implications, and they're still having trouble getting to some type of negotiation. That's supposed to come into fruition before the middle of June. So we're still on standby for that. Remember, they mentioned in yesterday's report that they're supposed to come to some type of agreement before the G7 meetings that are set to take place the second week of June. So just be mindful of that, right? That could be something where if a negative headline comes out, the market has not priced it in yet, and we could see a shock to the downside. Any escalated tensions in the Middle East right now, clearly Russia, Ukraine aren't really having too much of a muted effect. It seems like the markets maybe already priced Russia, Ukraine in. I don't think that the markets have priced in a massive like bombing or something that could take place if the United States attacked Iran because they can't come to some type of nuclear agreement, right? Don't think that's going to happen, but it's still something that we need to be mindful of that could create a downside shock to the markets. I'm trying to think of what else. Any excessive. Right. So I just wanted to play that for you guys real fast. We mentioned that if we saw a bombing between the United States and Iran, it was most likely going to create a downside shock to the market. We were key highlighting this $3 trillion area and potentially the May lows, which is not coming to fruition yet. But depending on how fundamental data comes out this week, we could possibly see a revisitation of that $2.8 trillion threshold. To continue this, okay, this is a report. Check this out from June 8th. So not only in our Zoom calls do we deliver and talk about this stuff, but if we go right down here, back on June 8th, here is the portion where we were talking about geopolitical risks beyond tariffs and how they could negatively affect the markets. And we said, an Iran nuclear deal's tension builds up. On Friday, U.S. President Donald Trump issued a firm statement declaring that Iran will not be allowed to enrich uranium, despite reports suggesting that the latest U.S. proposal might allow low-level enrichment for a limited time. They won't be enriching. If they enrich, then we're going to have to do it another way. The veiled threat, which alluded to a possible strike on Iranian nuclear facilities, came at a critical juncture. The U.S. negotiating stance has been inconsistent, frustrating key allies such as Israel, which continues to demand zero enrichment under any deal. And we said here in the market implication section, if tensions do rise and military options are seriously entertained, markets are likely to price in geopolitical risk premiums, driving up demand for safe haven assets and creating a risk off market mood, right? So this is again almost over a month in advance where we are prepping for this exact scenario, trying to just show you guys why it's so imperative that we pay attention. As for more specific price targets and price valuations, okay, this is kind of where we were talking about as a team. This is back from June 15th. Again, as of time of recording, it is June 22nd. I really enjoyed this Zoom call because this is where we kind of opened the floor and I had you guys build out our risk on, risk off scenarios. And the first one that one of you guys had mentioned, I believe it was either Cedric, Carlton, or D'Angelo, had said geopolitical tensions would most likely be a key factor weighing on risk sentiment. So this is that Zoom call. You guys take a second and just listen to this, pat yourselves on the back because now fast forward, here we are. Your prediction came into fruition. assume would most likely happen if we got the inverse of this. So let's just briefly touch on that now. And if you didn't give me something just now for the positive risk on sentiment, let's just try and be vocal and, community driven. So that way we're all learning. If you spoke just now and gave me these, try not to speak when we do the risk off. So that way other people can participate and we can see if people are paying attention. All right. So I'm going to make this small so that way you guys can't see it. And let's change this red so that it color coordinates with your psychology. We'll make this big. And then somebody give me one risk off event that could take place this week that could possibly deteriorate market sentiment further from where we're currently at.
Israel-Iran tensions.
All right, we'll put Middle East. And we also just need to be mindful. I'll cap on that and I'll put geotensions, right? Because we still have the Russia-Ukraine situation, and any major announcement from that jurisdiction as well could also weigh on sentiment. So Middle East, geotensions, we'll put increasing demand for safe haven. Right. So not only are we doing this here for you guys as mentors at CYPRX, but now you guys are really starting to pick up and pay attention, and I just love that. So I love having timestamps for things just to prove that what we talk about here, actually materializes. And then when we get into specific price analytics and delta zones, look at how freaking accurate these levels are. This is a June 16th analysis that I gave you guys on XRP, and I had mentioned if price is unable to break above $2.36, then the most likely scenario is going to be a risk off market sentiment, and we were going to start to pull back towards $1.99 to possibly $1.78. So think about this in terms of where the XRP community's mindset's at right now, who have no idea what's happening in price, probably think that crypto's a scam. Maybe they were buying at $2.36, putting $1,000 in. Now that $1,000 isn't worth that much money anymore, and their sentiment is just completely distraught, right? They're fearful. They're like, what the heck's going on? I thought XRP was going to freaking see massive institutional adoption this year. Oh my gosh. When in reality, we're still in a headline driven environment. 95% of the price action in the total cryptocurrency market cap right now is driven by arbitrage and trading, not utility, not freaking, especially on an asset like XRP, not DeFi, right? It's all just speculative trading. And so when there's a risk off market sentiment, whales sell their position for stable coins or for fiat or for other safe haven assets. And we see market deterioration and a pullback in riskier assets, especially like XRP, right? Because it's not being utilized right now wholeheartedly for its utility yet. It's still being utilized as a speculative trading vehicle. And when we're in a risk off market environment, we can assume that it's going to have a negative impact on price. And so here's where we talked about that. Take a second and listen. Inversely, starting on XRP, the bearish case, if sellers start to show their hand at $2.36, the sentiment worsens. Buyers are unable to overpower, and we start to see sellers aggressively show their hands. $2.09 is obviously, of course, going to be the revisitation level where we could possibly start to see a reaccumulation of buy orders and reassess market fundamentals. Okay. If we break $2.09, that's going to open the door for $1.99, which is our next buy delta underneath of that. I'm personally going to remain dormant and sit on my hands for some long-term bag positions to be filled on XRP if we can break $1.99 and we can head back down into $1.78 if sentiment deteriorated any further, where I would definitely start to accumulate some good XRP buy positions, maybe even possibly considering open up like a leverage long position with like $1,000 or something like that, with a nice stop loss, like $1.50 or something like that, especially if buyers started to defend at $1.78. So again, that was a video from June 16th. That was a week ago, and now you can see I haven't deleted any of our levels, any of our previous drawings, and now we're starting to make our way down towards that second institutional buy area of interest at $1.78. So we're definitely going to see if that price level can materialize this week, unless maybe buyers can defend at $1.98. That is where we're currently hovering at now. But this is just another prime example of why and how here at CYPRX, we don't buy at tops, right? We try to predict these things in advance to prepare ourselves for moments like this. We don't chase bullish candlesticks. We don't buy when price action is near sell deltas. We wait to deploy capital when price is at buy deltas, and we're given these areas of interest weeks, if not months in advance by our institutional scalpers. So this is just so much info on how you can come up here in this community, whether you're a dollar cost averager, a DeFi investor, or just a long-term bag holder. There's so much value that this community brings when you really truly understand the mechanics behind what drives this market sentiment. All right. So, with that being said, let's just briefly touch on some of the things weighing on the market conditions. Remember, I wrote this report yesterday. So, the only update that this report needs is that in this report, I talked about how Trump had threatened um, Iran and that that United States B-2 bombers were headed to Guam to possibly attack Iran, but then overnight that took place, that happened. So that's the only thing that needs to change from this fundamental report. Everything else still remains relevant. So let's just thoroughly read through this. Right now, crypto market fundamental breakdown as of time of writing. The total cryptocurrency market cap is down $90 billion plus on the day, continuing a week of risk-off sentiment driven by a potent mix of macroeconomic, geopolitical, and trade-related uncertainties. Despite strong underlying fundamentals in the crypto sector, which we'll get into in just a second, we remain in a headline-driven environment where fear and uncertainty are dictating price action intraday. So, three key reasons why price action has been rattled by market uncertainty. First, the geopolitical tensions, the escalated conflict between Iran, Israel, and the United States. Central bank confusion. Last week, we had mixed signals from Fed officials, including Jerome Powell and Christopher Waller, on the timing of direction, on the timing and the direction of interest rate cuts. And then number three, tariff risks. Delays and legal challenges around U.S. tariffs have also reignited trade war fears. Okay. So I'm going to skip the portion where it talks about geopolitical risks. I just kind of briefly went over that. We had the United States directly get involved with the Iran-Israel conflict, and they bombed Iran. And now we're starting to see Iran mention possible retaliatory measures. Who knows what that's going to look like, and who knows if the market has priced that in. So if we continue to see those conflicts elevated and further, we're most likely going to continue to remain in a risk-off market sentiment where that's going to weigh on risk assets and drive up demand for safe haven. Okay. But what I really want to focus your attention on is what we haven't talked about, and that is the Fed messaging. And last week, them delivering mixed signals and mounting confusion. So people will think that it's just the geopolitical tensions, but it's not. It's also the uncertainty last week that the Fed delivered and the tariff related implications that are also weighing on market uncertainty. Just keep in mind, the markets do not like uncertainty. And so when markets are uncertain, investors with much more capital than you and I, market makers, they tend to put their capital into safe haven assets until the conditions become certain and clear, and then they rotate out of safe haven assets when safe haven's at a premium, taking profit, and then they start to facilitate back into discounted prices on risk assets. That has not happened yet. We haven't seen that shift, so let's just be mindful. So last week, the Fed's monetary policy report acknowledged that tariffs may be contributing to higher inflation. I highlighted that in bold, but the full impact still remains unclear. Remember Jerome Powell last week, if you guys watched the FOMC meeting with me live, he said the word uncertain like 10 different times. Next time, honest to God, that I watch a Fed meeting and he says the term uncertainty or uncertain 10 different times, I'm just going to turn it off, not even watch the whole thing. And honest to God, we could just chuck it up to a risk off market sentiment, right? Jerome Powell's tone was cautious, citing unusually elevated uncertainty surrounding tariffs and inflation. Then later on in the week, Fed Governor Waller tried to come in and he contradicted Powell by stating that the Fed could begin cutting rates as soon as July if the data called for it, which again just adds another layer of uncertainty, considering that those signals are kind of mixed. Remember that markets crave clarity, and the mixed tone from Jerome Powell and Waller has left investors questioning not just the direction of policy, but the Fed's framework itself. This lack of confidence is unsettling for both equities and crypto. Then on top of that, we had trade risks. So the Supreme Court last week rejected an expedited challenge to Trump's use of International Emergency Economic Powers Act, or the IEEPA, to impose tariffs. The decision delays legal resolution, leaving current tariffs in place. That is important. I'm actually going to highlight that, leaving current tariffs in place, while businesses and consumers face elevated costs. On the Chinese front, the US and China did reach a tentative agreement on rare earths, but reinforced concerns still remain. On the Japanese front, they reported no progress in removing U.S. auto tariffs. Here's a little snippet of that article where it specifically says Japan's top trade negotiator Akazawa said on Friday, this is again last week, that trade negotiations with the U.S. still remained in a fog, despite efforts by both sides to seek an agreement. So I included this. You can see it's a recent report from June 20th. Just this goes to paint the uncertain landscape that we're currently seeing right now. Um, and then we also have some uncertainty from the EU. So you can see here, EU negotiations also show some signs of misalignment in digital policy and still remain unresolved on core tariff disputes. Here's a little kind of snippet of that. So it says, but the text that people said does not specifically address any of the tariffs that President Trump has threatened or imposed on the EU. That is not good. Okay. They don't like it when there's no specifics, when there's no clarity, when there's no certainty. So I made sure to try to highlight that key vocabulary for you guys so that when you're learning these fundamentals, you can see things like that and say, oh, yeah, that definitely paints an uncertain picture. And you can gravitate towards implementing that in your fundamental analysis. Then they also said it does not detail the EU's proposed retaliatory tariffs that are set to kick in on July 14th. That term, retaliatory measures, if we see that in headlines, markets don't like that because who knows what those retaliatory measures are going to look like, what type of effect that's going to have on the market. And so, again, it adds another layer of uncertainty. And then here you can see the term unclear. I highlighted that unclear, uncertain, unstable, right? Markets don't like that type of terminology. They like the inverse, the opposite words of those words. Okay. So the bottom line is trade uncertainty is still a major overhang. Progress is too slow to lift market sentiment, and any escalation further could pressure risk assets. On the data front, all right. All right, I'm not going to talk about last week's data. I would rather talk about the upcoming data that we have this week. All right, so upcoming this week, we have a very impactful week ahead. Tomorrow, we have PMI figures. I believe it's on Wednesday, excuse me, or Thursday. We have core PCE figures, we have GDP figures, and we have unemployment claims, along with a testimony from Jerome Powell. So this is going to be an extremely volatile week because adding a layer on top of all this, we have tariff implications and geopolitical tension headlines that we're going to need to be mindful of every single day. So with that in mind, all right, I'm still setting in current discount positions. I let you guys know in the chat today how much capital that I was deploying and how much capital I have sitting on the sidelines in case we go lower. Understand the market dynamics right now is extremely critical. All right. So outside of the headlines, the tariffs and the geopolitical tensions, okay, let's just talk briefly about those. Right now, the market is priced in the bombings right now that just took place. So in order for the markets to continue to deteriorate further, retaliatory measures or any new headlines that are not priced in could obviously, of course, weigh on market sentiment further. So if we see, for example, new announcements that Iran is getting further involved or possibly directly attacks a United States ally or United States infrastructure overseas. Like, for example, you know how there's like there's United States embassies overseas. If Iran chooses to try to attack a United States embassy, whatever the case may be, any type of headline that again further escalates the situation that's not priced into risk assets yet could further dampen sentiment. Same thing with tariffs. If Japan, which we're still waiting for trade talks to come into fruition, EU, China, if any of those major jurisdictions come out and say, look, we're not getting into terms with the United States, they suck, we're going to continue to argue with each other, that could be further priced in, and we could possibly see a further deterioration in market sentiment from where we stand, possibly pushing through that $3 trillion threshold and making our way down to $2.8 trillion as our next bearish overall target. All right. Primarily, though, what I want you guys to focus on, what we need to see this week in terms of the data. So looking at the data, as I mentioned, Monday, PMI figures. Tuesday, we have Jerome Powell's testimony. There isn't enough data before his testimony to change what he has previously said. So honestly, I'm expecting a muted reaction from Jerome Powell's testimony. Unless he comes out and flips the script completely, That could obviously be something that we need to react to. So we will be monitoring for any dovishness in his tone, but we haven't really seen, or excuse me, we don't have any major data events that are going to happen before his testimony that will most likely change his sentiment from the last statement that he made at the FOMC meeting last week. So he's probably literally just going to reread his FOMC statement to Congress, and then Congress is going to ask him questions, and he's going to probably reiterate the same exact shit that he was saying to people, the reporters at the FOMC meeting. Guarantee you that's probably what's going to happen. If anything outside of that happens, then it will create some market volume and volatility, but I don't really see that. So that means most likely that the market's going to continue to weigh on rate cut bets because Jerome Powell's commentary last week was quite uncertain and didn't really provide the markets any clarity on when rate cuts are going to take place. So it's probably going to be a non-bullish day for crypto. All right. We also have CB consumer confidence. And then Wednesday, again, Jerome Powell still in his testimony. Thursday, we have GDP, unemployment claims, durable goods orders. And then Friday, we will end the week with the core PCE, which is the primary inflationary metric for the Federal Reserve. Okay. So extremely important. And then, excuse me, also we have consumer sentiment and inflation expectations, which will also be important on Friday. So every single day, intraday, I'll give you guys updates on what we would ideally like to see, but just to set the tone. Okay. Typing all this data into ChatGPT and just simply asking it, right? What would be the ideal scenario for us to see in terms of the data and how we'd like it to come out to support a risk on market environment? All right. So, in terms of Jerome Powell's testimony, we would like to see him deliver a dovish tone, mention continued progress in disinflation, or any mention or room to cut rates or the readiness to act if labor markets do continue to deteriorate or weaken, or if inflation continues to cool. Those types of comments would support rate cut bets. But like I mentioned, there's not enough data for him to change his sentiment from last week until this week when he delivers that sentiment or that testimony. So I don't really see that happening, but it's possible. As for the PCE inflation, core PCE, we'd like to see it at or below 0.1% month over month, matching the market forecast, or lower. We would also like to see the annualized or the year over year PCE falling closer to or below 2.6%. As for the personal spending and income figures, we'd like to see spending come out soft at 0.3% or below, and income come out weaker than expected at 0.4% or lower. This would suggest weaker consumer demand and easing wage pressure that would equal to the market starting to price in lower inflation risks. That is a key highlight right there. If we can see that in the headlines and the fundamentals, that there is a lower risk to inflation spiraling out of control because we see softer spending and income, that's going to boost risk sentiment or could be a catalyst that provides a tailwind for risk assets. Durable goods order, same thing, a mute or a rebound below 4.5%, which is the forecast, or signs that the core capital goods remain soft. Weak business investments equal a cooling economic momentum. Flash PMI, same thing, soft figures, preferably below the 50 grade threshold, or any figures showing signs of contraction. Right? We don't want to see an economy that is overheating or heating up, expanding. We want to see an economy that's contracting, which opens the door for the Fed to possibly cut rates later on this year. Consumer confidence figures remaining relatively elevated, but inflation expectations coming down. All right. And then GDP figures, same thing. Any downward revisions or contractions in GDP figures showing growth was weaker than previously thought, reinforcing slowdown in the United States economy. All right. If we see the inverse of any of these things, upbeat figures, economic expansion, strength and stability in any of these figures that prove what Jerome Powell was saying at the FOMC meeting, that the United States economy still remains solid and resilient, then that's going to push back on the rate cut bets. It's going to be more data that we're going to have to take a look at. The Fed's not going to want to cut rates because the data is not supporting it, right? And it's just going to continue to weigh on market sentiment, or at least not be a catalyst that boosts risk assets. Okay. So the bottom line, the more data The more that the data, shows slowing growth, moderating inflation, and softening consumer business activity, the more confident the markets will most likely become that rate cuts can arrive sooner rather than later, possibly as early as September. I personally don't see this happening. I think that the market's going to continue to push back on rate cuts until something breaks, which is going to force the Fed's hand to cut rates like they did last year in September. All right. But we'll see. We'll continue to play this day by day as the data comes out. All right. So as of right now, market sentiment is still risk off. On the drop of a dime, though, guys and gals, just be mindful why I'm taking advantage of these discounted prices, because the underlying fundamentals in crypto are still excessively bullish. There is nothing, like literally whatsoever right now wrong with the infrastructure in crypto. Regulations are coming into pass. Freaking institutions are like full force adopting and getting headstrong about DeFi. There's been massive summits and major announcements from huge globally systemic important banks talking about adopting public blockchains for the first time in history. Solana, institutional grade partners with Drift and Apollo announced a freaking looping strategy where institutions can earn 17% participating in DeFi this year. There's just so much happening in crypto that people, because of this fear-based mindset that takes place when the markets pull back, don't really see through these trials and tribulations that we all have to experience, that crypto kind of comes inherent with volatility. Look past that, understand why the market's down temporarily, and see behind the curtain that as soon as the geopolitical tensions and the tariff implications subside, we are probably going to see another huge leg up. And it seems like right now the markets are preparing for that. Again, once we see price come into a discount, we'll eventually find a floor. Larger investors than you and I will eventually start to facilitate buy orders and buy volume in this market. And I'm going to go ahead and assume at that point in time, we'll start to also see the sentiment turn around. And yeah, you don't want to be caught off guard, not putting yourself in positions now when the market's at a discount when that sentiment returns. And all it's going to take is one positive headline. Trump coming out saying some shit like, all right, me and the Iranian leaders just high-fived with each other. I mean, it's not going to happen, but if he did, and if it would happen, that would send the market back in risk on territory significantly. We'd probably see $100 billion come back into this market day one, right? If Japan and the United States announced a trade negotiation that benefited both jurisdictions and eased this fear that inflation is going to spiral out of control because of high tariffs, that could also be a catalyst, or made from any major jurisdiction, China, UK, freaking Canada, Mexico, EU, any positive announcements surrounding tariff implications, one headline right now is positive or could be positive enough to drive market sentiment back towards risk on. So let's just continue to play this day by day and week by week and continue to keep our ears to the wire. So just to show you guys what I'm talking about, to back my thesis, right, that you should not be fearful. Okay, this is again all happening for the first time in history, and this is going to be a little DeFi specific to show people that institutions are for a fact going to be participating in DeFi, which will give us in this community a little bit more confidence that what we're doing, it to some degree, there has to be some stipulation behind the scenes that we're not seeing, that being a participant in DeFi is not illegal, because banks and institutions are doing it right now. JP Morgan has become the first systemically important bank. This is announced 3 days ago from Block Stories, or GSIB, to issue a deposit token on a permissionless blockchain. Okay, and so here is the direct announcement, and it mentions deploying on public infrastructure starting with Base. This is about meeting client needs, or the future is happening on chain. It's JP Morgan giving institutional clients access to tokenized financial assets of the future without losing them to stablecoin rails or fintech challengers. So they're again just trying to remain in control. And what I like here is that in this commentary from this guy, Max, the founder of Block Stories, mentions that they're starting with Base. I like that vocabulary because it implies that there's going to be more announcements later on down the road. So just plugging this in the chat GBT so we can understand this in layman's terms. This is a massive confirmation of crypto's trajectory, and arguably one of the clearest signals that traditional financial players are not only seeing blockchain as inevitable, but they are now actively building within it. JP Morgan, again, a GSIB, and if you guys have ever read The Creature of Jekyll Island, okay, you should know that JP Morgan was a massive key participant in the building out of the traditional financial system in the Federal Reserve, right? And now look at how they're playing their hand in DeFi, crypto, blockchain, Web3. They're in all the leading articles, okay? And they're the first globally systemic important bank that has taken a tokenized deposit into a public blockchain for the first time ever. Okay, I don't think that that's by accident. I think that it's all systemically planned. The token is launching on Base and Ethereum Layer 2, built by Coinbase, a chain rooted in crypto native infrastructure. This isn't a random experiment. It's their commercial bank division, Connexus, leading the move that's real TradFi capital and infrastructure integrating directly within decentralized rails. The phrase starting with Base is not a throwaway line. It signals that JP Morgan plans to roll this out across multiple blockchains, depending on traction and interoperability. They are meeting clients where the future is happening on chain. Keep in mind, I'll just throw this in there. XLR was one of the blockchains that JP Morgan tested in collaboration with other major market participants like Deutsche Bank and the Monetary Authority of Singapore. Not that that's relevant right now, but just something to keep in the back of your mind. This is also a report recently shared in our private CYPRX Discord from Goldman Sachs. So again, just showing you guys institutional perspectives. They're not scared right now of the market landscape. These large participants are actually the ones telling you, look, y'all, we're bullish right now. So it says here, over the last 12 to 18 months, we have seen significant shifts in corporate and institutional interests, not only on the back end of the crypto ETF launches, but also in light of the changing sentiment in the US and a more favorable stance on digital assets at large. As a result, many institutional investors who previously sat on the fence and were reluctant to get involved are now actively formulating strategies and building out dedicated teams for this space. It is certainly an exciting time, and the markets are actively, sorry, hold on, and the market is active. Let me start that again. And the market activity has undoubtedly picked up, but we feel that there is still such a long way to go. So this not only lets us know that we're early, but from an institutional perspective, they're literally telling us that the sentiment has completely shifted. 5 years ago, maybe even 2 years ago, you would never have seen a document like this from a large organization such as Goldman Sachs or JP Morgan. Okay. Then this was also recently posted just 3 days ago to prove my case about institutions and institutional infrastructure providing staking and DeFi opportunities for hundreds of financial institutions. This was just announced from P2P. P2P, for those of you all who don't know, has over 130 plus institutional clients and offers staking capabilities for large financial organizations. All right. And they just announced this. Solana rewards have now landed at Fireblocks. Fireblocks users can now stake Solana directly with P2P and immediately access triple staked Solana rewards of 9.40%, outperforming the network average of 9.16%. So it seems almost like they're chasing high yield as well, right? P2P offers a unique combination of rewards that you won't find anywhere else. Solana staking, MEV rewards, and block rewards. This latest integration delivers easy, secure Solana staking directly within the existing Fireblocks workflow. No extra steps, no complexity, just better rewards. Institutional Solana staking is now easier, faster, and more secure with rewards from P2P leading the way. Then if you head over here to this report, where it gives you guys the link for this. This is kind of just the whole entire breakdown, and it mentions right down here, by staking with P2P through Fireblocks, users now finally get direct access to their rewards ecosystem, where they can automatically compound every 2 days to maximize their growth. So what do we talk about here in this community? Taking a staking approach, sitting back, letting your assets accumulate, and just literally compounding those rewards every single day with a long-term horizon vision. Right? And now institutions can do exactly what we've been doing in this community for over a year now, right? This is another one from Fireblocks. This is another report where it just talks about the institutional infrastructure that they're building. And right down here, just one key highlight, it mentions that Fireblocks is the network that offers a platform designed for interoperability and connectivity that lets firms add DeFi access, staking modules, and tokenization layers without re-architecting their backend infrastructure. So it specifically mentions that this gives them direct access to DeFi capabilities, right? Here's another on-chain fundamental that just took place. The on-chain yield landscape is maturing as institutions and users seek more sophisticated opportunities on-chain. This is in collaboration with EtherFi, Maple Finance, Ondo, Athena, and MO. If we come over here, this is the report, and I just want to read the two top highlights. It says, the DeFi landscape for stablecoin yield is undergoing a profound transformation. A more mature, resilient, and institutionally aligned ecosystem is emerging, signaling a clear shift in the nature of on-chain returns. This report, leveraging insights from Vaults.fyi and Artemis.xyz, unpacks the key trends in shaping on-chain stablecoin yields, from institutional adoption and infrastructure development to evolving user behaviors and the rise of sophisticated yield stacking strategies. Then it talks about institutional DeFi adoption, a quiet momentum that is building. Even as nominal DeFi yields on assets like stablecoins recalibrate relative to traditional markets, institutional appetite for on-chain infrastructure is steadily building. Protocols such as Aave, whom we have a DeFi mentor in this community that has effectively shown you guys how to use Aave in a profitable fashion during huge market downturns, including the one that we're experiencing today, Morpho and Euler are attracting attention and usage. This engagement is driven by less by the pursuit of absolute highest APYs and more by the unique advantages of composable, transparent financial infrastructure, now bolstered by improving risk management tooling. These are not merely yield platforms, they are evolving into modular financial networks undergoing rapid institutionalization. As of June 2025, leading collateralization platforms such as Aave, Spark, and Morpho collectively held over $50 billion in total value locked across these three platforms. 30-day lending yields on USDC range from 4 to 9%, broadly at or above traditional benchmarks like 3-month US Treasury bills, which yielded an average of 4.3% over the same time period. Institutional capital continues to explore and integrate with these DeFi protocols. That is a huge sentence right there, right? That's confirmation. Institutional capital continues to explore and integrate with these DeFi protocols. The persistent attraction lies in the unique benefit of 24/7 global markets, atomic settlement, composable smart contracts, enabling automatic strategies, and enhanced capital efficiency. This literally sounds like everything we talk about throughout the week on a daily and weekly basis. Okay. It goes on to talk about this platform down here. So it says, as on-chain asset managers continue to pile in, Maple is tuning in with the latest trends in both yields and products powering them. And check this out. So this is from the beginning of the month, June 12th, 2025, or a week ago. And it says Maple expands institutional stablecoin lending with STETH, where Maple Finance, a leading on-chain asset manager, has added support for STETH, the leading Ethereum liquid stake token issued via the Lido protocol, enabling institutional stablecoin lending. This, in addition, enhances the institutional utility of STETH and further solidifies its role within the Ethereum ecosystem. By enabling institutions to borrow stablecoins against STETH holdings, Maple provided access to liquidity without requiring institutions to exit their liquid stake positions. Institutions can now maintain exposure to liquid staking rewards while efficiently addressing liquidity needs for treasury management, operational working capital, or other strategic financial activities. Why did I show you guys this? Because if you remember in our call yesterday, or was it the day before on Friday, when we were talking about the individual influencer that posted buying a house with 100 XRP in the future. And instead, we revamped that and we said, well, why would you do that when you can go and you can liquid stake your XRP? Then you can take your liquid stake XRP token that you get. You can then go and lend that out on a lending platform like Strobe Finance, maybe in the future. You can then borrow against that liquid stake token. So now you're earning on your additional XRP because you liquid staked it. Then you're also earning on your liquid stake token because you lent it out. And then you borrowed against that. So you keep your liquidity in the market and now you're liquid again and you have capital to go out and deploy. And then you can go and do whatever you want with that capital while still maintaining your position. We've already discussed that. So again, we're just front running the financial institutions in all this who are just now kind of catching up and realizing, oh crap, we should probably get involved before we get left behind. And they are, for a fact, right? So this just backs my thesis as to why I continue to tell you guys understand the fundamental landscape in the short term, that all of these things, these headwinds weighing on risk assets right now, they're temporary. And once they're lifted, regardless if they take another month, 6 months, or maybe even a year to fan out, when they are gone from the markets, we're probably going to see a huge price appreciation event take place in the total cryptocurrency market for specific assets that are focused on things like this institutional DeFi adoption, opening up corridors and infrastructure for institutions to partake in this space. I cannot stress enough that on days where we're seeing $100 billion gone from the market, I've not seen it negatively impact anybody's portfolio that takes advantage of days like this, right? Zooming out and looking at this market long term, the market usually always recovers as long as you're getting into assets that aren't, you know, scammy, fishy, weird meme coins that don't have a lot of TVL and don't have a solid team backing behind it. Again, just focus on blue chips, not financial advice. Focus on blue chips, focus on assets that you can stack, stake, and yield, earn rewards on, and just build bigger bags while the market is freaking out. Everybody's panicking and has no idea what the heck is going on. And now is the time to lock in and focus. So that's my spiel for today. That's how we'll kick off the beginning of this week. We'll host another call throughout the remainder of this week to continue to cover fundamentals as they change. Outside of that, I'll leave the floor open for questions, commentary, if you guys want to just have general conversation for a second. But that's my spiel for today.